In this video I will be teaching you how fair value gap works and the fair value gap trading strategy that you can start trading today and be making a lot of profits from the market. Nobody will ever teach you these secrets that I am about to reveal in this video. And by the end of this video you will be able to take trades like this and this every day in the market. If you skip any part of this video, you will be making these strategies a very hard one for yourself. But before we move into these concepts, do well to like this video so that other traders can find it and also become profitable, and subscribe to our channel if you are new here. Now, my tribe soldiers, let's get down into this business. First of all, what are fair value gaps? Fair value gaps are areas of imbalances on the chart. These imbalances are caused by a sudden unexpected gap between candlesticks in a surging market. The fair value gap structure is composed of 3 candlesticks that are moving fast in the same direction of the market. This is a bullish fair value gap, and the structure is composed of 3 candlesticks. The first candle, the second candle, and the last candle. The middle candle is the point of interest among the other candles in the fair value gap formation. It contains the gap between the other 2 candlesticks. But how are these gaps formed? The gaps are formed when the first candle's high, or let's say they wicks, did not trade much into the middle candles, and also the last candle's low did not trade to low into the middle candle, thereby giving us a good gap in between the wicks of the first candle and the last candle, and the fair value gap is then drawn from the middle candle, from the space between the wicks of the first candle and the last candlestick. This is not an ordinary gap in the market. It reveals something to the traders. It shows an imbalance in the market, which needs to be balanced. But why is the fair value gap so special in the market? Watch this now. This is what a normal balanced candlestick movement looks like in the market. And now, compare it to the fair value gap and see a huge difference. See that they are not the same in structure. The fair value gap has a great space in between, showing imbalance, but these normal candlesticks movements has no good space in between them, as they always move in a balanced state. You can see that here, that the wicks of the candles are always overlapping each other as the market progresses. There is no space at all between the wicks and the body of the candles. And this is the regular candlestick movement that we find a lot of times on the chart. This is now showing us the peculiarity of the fair value gap. So think of the bullish fair value gap like you are climbing up on a staircase, and then you jump over 2 or 3 staircases, which now becomes an imbalance, which is actually a bit hard for every normal person to do. And you mistakenly dropped something of value, like your phone or a bundle of cash, which you will only remember when you have climbed very far from that spot. And since you have created that imbalance and dropped your valuable stuff, you will have to return to that spot again to correct your steps, take your valuable stuffs, and climb up again. But this time, you will be climbing up in a balanced state, because you don't want to lose that bundle of cash or phone which contains the contact of high-end business clients. Use this illustration to always remember the bullish fair value gap. Now, the bearish fair value gap is the same in structure formation, but in a reverse state. In a bearish fair value gap, the market is moving down in a downtrend. So here we have the first candle, the second candle, which is the middle candle, and the last candle. See that here, the wicks of the candles gave space for the middle candle to create a fair value gap, which cannot be found in a normal bearish candlestick movements, like this one here. Here you can see that the market is constantly overlapping each other with candlestick wicks, giving no space at all, so they all move in the same direction and create no special candlestick movement in the market, with which the traders can actually pick as a point of interest. That means they only pass through price. They never created anything of value. Now, you can think of it with the same illustration as we used in the bullish fair value gap, but this time, think of it like you are climbing down those staircases and you suddenly jump down 2 or 3 staircases. Let's just imagine you did not break your teeth in the process, and you mistakenly drop something of value by the time you roll down the other staircases, or maybe by the time you climb down the other staircases and have gone down too far, you then remember that something of value fell off, which I believe is very important to you. You will have to climb back again to the spot, pick your valuable stuffs again and climb down in a balanced state, remembering your teeth you have just lost, or a broken arm, or maybe nothing at all if you are lucky enough. But all threesome, use this illustration to keep the fair value gap structure in mind. That is exactly how the fair value gap works. And now that you have known how the fair value gap works, the next question is, how can we trade the fair value gaps correctly and make money with it? The fair value gap strategy. But before we get to that, I want to take out time to tell you all about our Telegram channel. We now have a Telegram channel where I drop all my signals and trades, and a lot of high value informations and tips that will help you to become a profitable trader fast. And there you can gain access to me faster, and I will reply your messages in minutes. Now, back to our fair value gap strategy. The truth about the fair value gap is that it does not work at random areas in the market. It only works at very strategic points in the market. Now, there are some traders that will tell you to enter a trade at any point you see the fair value gap. But hey, although the fair value gap formation is very special in the market, the truth is that they work better at special areas in the market. If you trade the fair value gap at random areas on the chart, you will be shocked to see how bad your trades will perform, even with this special concept, since you are shooting random shots in the market instead of becoming a sniper. The best area that I like to trade the fair value gap is the base zone. This base zone is like the supply and demand areas in the market, the areas where the market has made a bit significant movement, along with the fair value gap. These are the areas where the fair value gap really works. So you want to find the fair value gap formed before a significant price movement in the market. Let's say this market was moving down, but when it got to a particular zone in the market, it began to make a significant price movement, even more than the former price movements. And before this price moved up, the market formed a fair value gap, causing an imbalance, which means that the market will have to return to the fair value gap to balance the movement. And when the price returns to it, it will trigger the market price and move it to the target direction. And we are going to be part of that movement to the target direction. But here is something you must take note of. In order to make this strategy a strong one, before the market returns to the fair value gap, we want to see this little price retracement to the fair value gap. I call it a small retracement, but many traders use this little retracement to get into the market when it retraces to the fair value gap. But that is wrong, because 80% of the time, the market will always come back to trade below that little retracement and completely fill the market orders. And when it has completely filled the market orders, it starts rising up exponentially. It is always safer to enter the market when it has completely filled all the orders. Now let's take an example of this fair value gap strategy in a bearish market. Now, here we have the market rising up, and then we started seeing the market making some significant price movements than the other price movements, and at the base of that movement was a fair value gap formation. Now this is important. We want to always see the fair value gap formed at the base of the price movement. We don't want a fair value gap when the market has moved far from the base. It is best when it forms at the beginning of the zone. So now we have the fair value gap formation at the beginning of the base. And see that as the market was making those price movements, among them was a little retracement to the fair value gap zone, which was made by the small retail traders, and that the market will take out when it returns to the zone. And when it came back to the zone, it took out the little retracement, filled the orders, and traded into the fair value gap. When you see this, you place your stop loss a few pips above the fair value gap, and you'll take profit target at the next low. And as you can see, this trade was successful. Very easy to say. Now, Let's take a look at one more example before I tell you something. Now, here you can see that the market is moving down, and then it got to a point in the market, and the market started making a significant price movement to the top, and at the base of the movement, we can see a fair value gap formation, and also see the little market retracement to the fair value gap, which the market will take out when it returns to the fair value gap. Remember, we are only taking fair value gaps that had a little retracement to it before the market moved up. So here the market returned and took out the little retracement and then traded into the fair value gap. So we can place our stop loss a few pips below the fair value gap and our take profit target at the next high. And here you can see that the trade was a successful one. This fair value gap strategy can be used to trade reversals and trend retracements, but no matter what you do, always trade this strategy on one time frame. Don't find the fair value gap on the 4-hour time frame and then start looking for an entry on the 1-hour time frame or the 15 minutes time frame. Always focus on one time frame while you are trading it. And if you want to learn how to combine fair value gaps and liquidity to advance the way you trade the fair value gaps and boost your profit margin, watch this video where I taught on how to combine liquidity trading and the fair value gaps together, using these two strong concepts to trade the market. We are the Trading Tribe, and it's a wrap for this video. See you in the next one.